let's get right into how the central bank might go about that process of hiking interest rates. And for that, we have an expert on the show. Tim Duy is the SGH Macro Advisors Chief U.S. economist and joins us now. Tim, it's great to have you on the program. I just kind of walk through the basics of how exactly the Fed rate hike impacts things. But I guess from your view, what was the big significant takeaway from the Fed's announcement yesterday? Because it seems to be less about what they did yesterday and more about what they're going to do in the next year or two.
Correct. The Federal Reserve made some pretty clear signaling through the dot plot that it expects this to just be the first of a series of rate hikes. We know that the Fed now really views inflation as a pretty serious problem and would really like to start getting on top of that problem. And in order to do that, it needs to get rates up closer to what it thinks its neutral rate is, or the rate that isn't causing inflation to accelerate. And that rate is, they estimate, 2.4%. They expect that we were going to get close to that by the end of this year, and then up over that by the end of next year. And that's the big news here, is that these dots were much more hawkish than was widely anticipated. There was a lot of signaling from Fed presidents ahead of time, talking about 3 or 4 rate hikes this year, whereas the dots signal 7 rate hikes, which I think is much more consistent with the economic outlook. But certainly it was a big leap from what we saw in the December meeting.
So, Tim, what was interesting about the commentary from Fed Chairman Jay Powell in the press conference yesterday was that, look, we're going to do what we can to take inflation down, but that's something that's not going to happen immediately. And the Fed's own projections show that their preferred measure of inflation will still likely clock in at 4.1% for the year, which is well above the Fed's 2% target. How do you feel the Fed's lag when it comes to when it actually raises interest rates and when that expects to have the so-called bite into inflation is going to occur? How do you feel that's going to develop over the course of this year or maybe next?
Right. Well, that's a very good question. Unfortunately, for right now, the Federal Reserve is behind the curve, and actually, I think Chairman Powell made that fairly clear yesterday when he said we needed to restore price stability. The only reason we would need to restore price stability is if we lost price stability. And so really at this juncture, the Fed is stuck playing catch up to the economy and to the inflation outlook. They really can't obviously do anything about inflation right now, or the inflation we're going to be seeing in the near term. The idea here is to start getting rates up, start slowing economic activity from where a really fairly rapid pace that we've seen over the past year. And then hopefully by that mechanism, start to put some downward pressure on inflation in 2023 and into 2024. That's the objective the Fed is shooting for. I think one of the real issues that still is in these dots, in these forecasts, is really most of the inflation is still viewed as largely transitory. The Fed really never gets rates terribly into restrictive territory in the latest dots. Yet inflation is still falling from the current high level, and that really is signaling that the Fed still believes that much of this will dissipate on its own.
And then the big picture question here is the R word, recession. The Fed chairman saying yesterday that he feels the risk of recession from a Fed-induced kind of hiking cycle is low. What do you think of the Fed chairman's commentary on that front? Do you have concerns about the Fed hiking, especially at the pace that it's going right now, too quickly?
No. So I'd sort of make sure that we understood when Powell made that commentary, he very said clearly, in the next 12 months or the next year. So that's a pretty a specific time frame, and the odds of a recession over the next 12 months are in fact extremely, extremely low, in my opinion. That the Fed isn't really anywhere near creating a recession that quickly in the economy. Sure, I think that anytime you're in a tightening cycle, you do have to think you're close. You're looking at the beginning of the end, so to speak, for the expansion. Now that could still go on for a long time. The last cycle started in the last hike cycle started in December of 2015, and you didn't get a recession until the pandemic hit in 2020. So, we're still possibly quite a ways from recession. My concern on this issue is that typically a lot of the indicators that I look at, such as wage growth, such as inflation, such as job openings, typically don't roll over in the absence of a recession. Which means that if it really needs to get control of inflation, it may have to force a recession on the economy at some point. That's not what the Fed wants to do at this point. I think that the Fed would like to kick that decision down the road as long as it can. And certainly that's a reasonable policy approach.
Yeah, engineering that soft landing going to be very difficult, especially with all the other geopolitical risks out there. But Tim Duy, SGH Macro Advisors Chief U.S. Economist, thanks so much. Have a great day.